Hi everyone, and happy Thanksgiving to you. I decided that for this weekend I would make a video, and the video was actually recorded on November 25th in the early part of the session. So some of the prices may be a little bit different, obviously, as you watch the video, but the content is meant to be evergreen. My name is Michelle Schneider, Mish, Director of Trading Education and Research at MarketGauge. This following video, you will see not only support and resistance areas, risk reward, and trading recommendations for the individual indices, also for the modern family and specific ETFs. And then I end with a look at all of the different commodities from oil, metals, agriculturals, and softs. So I hope you enjoy. I'll come back at the end to wish you all a happy Thanksgiving. And of course, please send any questions or comments that you might have to mish@marketgauge.com. So now what's really interesting to me right now is if you're first planning to buy these indices right here, I think that you have to think of things through. Number one is you have to think about risk reward. Number two is you have to think about the fact that Friday is a half a day, and if you guys are traveling, you're not going to be around to watch, and we never know how Black Friday is. And point number three is the fact that we still have some volatile situations happening geopolitically. And finally, number four is where you're buying in right into resistance. So here's IWM is a perfect example. Yeah, it certainly looks good. It certainly looked a lot better to me when it cleared 116. At this point, though, now, even though we got through the 65 weekly on an intraday basis, it's meaningless until we see what happens on Friday. So let me show you what that chart looks like. Here is the 65-week moving average. We broke above it like 4 weeks ago, then we had the big smash down, and now if we can get back through, that's a good sign, but is it the end-all be-all sign? So let's take a look at that. 118.78 is your 65 weeks. So next Friday, this coming Friday, that will be a key point to clear. And if it doesn't, then I would be wary going into the following week. Now also, though, this 119.36, I'm going to call it one up to 119.50, is resistance just on the basis of the fact that we've tried that area now a couple of weeks in a row and haven't been able to get through. So when I talk about risk reward, you would have to use a monthly low if you are interested in buying IWM at 113.36, because you can see that's actually sitting right here around this 23 monthly moving average. That makes me a little uncomfortable. That is a $5 risk. That's a lot. That's actually almost 4 ATRs or 3 ATRs. So one of two things has to happen. As far as I'm concerned, if you're not already long down from around 115, 116 against the 50, I think you just have to sort of sit it out and maybe find some of the smaller cap stocks that are in better situation in terms of risk reward. Now, if we go over to SPY, we have a very similar situation, except that you're a little bit close to the 200, but look how close you are to the resistance at 213. So at this point now, I think it would be very difficult to take a tremendous stance that this market is going to continue to fly. And even if you thought so, I would definitely not be looking necessarily at the indices. The best one really is the Qs, because you can use for a more active trade the 10-day moving average here at 112.89. I'd probably give it a little bit of room. But of course, we all know now that it needs to clear. So what you want to do is you want to try to get in on some type of either opening range reversal. So let's see what's happening here today. See, yesterday with Qs we broke down and we got to S2. So that means using pivots, we got, first of all, negative pivots coming into today, as you can see right here. R1 is all the way up here. That's not so bad because it's still relatively close. R1 coming in at 114.64 down to that. Here's your 10-day moving average. That's certainly well within reason. Or if the other choice would be to, we didn't have one yet, is if we get an opening range reversal, which means it has to break the 30-minute low or match the 30-minute low and then come through it, then at least you have a really reduced risk. But other than that, and considering NASDAQ is the strongest, The others I would sort of stay away from right here, like I said, because I'm not really crazy about the risk reward. And then here is diamonds. Of course, you know, you've all heard me talk about Terra at 18,000. This is where Terra begins, right up here. And at this point, again, not a bad risk down to the 200. I would rather use the 50 and the 100. I think giving things more room has made more sense these days. But still, I would probably want to see my granddaddy IWM prove itself the most before I got very confident in any of the indices. And that would mean, like I said, a weekly close above 118.80, and then we'd have to see follow through to get past all this resistance. This is resistance that goes back to August when we had the big crash. So here is Granny Retail, and I'm actually at least encouraged by what I see here in that we had a double bottom situation. Remember I said I needed to see more evidence of that, and I was looking for this gap to be filled, which once it was filled earlier in the week, or actually Friday of last week, that was a good sign, and then you had an opportunity to wait for it to hold with a good risk if you bought around 44. Question is, though, would I be buying up here? Well, you are going to get a potential phase change. We need 2 days over that 50-day moving average. But also look at the resistance you've got going on here between 47 and close to 48. So now you have to say to yourself, well, again, what is my risk reward? And do I think that the retail sector is going to keep going? So that's why I like to look at some of the top stocks in the retail sector, starting with Michael Kors, which I think looks really good here, but once again has 45 major resistance it has to clear. Another one of my favorite ones would be Kohl's. Kohl's broke out over the 50, but you can see that it has tremendous resistance coming up here at 50 based on all of this work before it collapsed one more time. And then I mentioned UA last night in the email. Well, United Armor, I actually think had a nice reversal here off of the new low, the inside day close near the highs and the follow through. You have a decent risk down to the 200, but you can see a declining 50. I'd say this, if this is again a sort of a double bottom situation, you could probably say on an active trade it's got to hold around 90. On a more of a swing trade, it would probably have to hold somewhere down here to around 87.5. It's got a big ATR, and you'd be playing it on the basis of the fact that it filled this gap and you think it has enough gumption here to get back up over like 97, or at least up to 97. So that's, again, you have to think about your risk reward. So if, for example, you were willing to risk down to 90, a couple of dollars, now you're talking about 3/4 of an ATR. So if you want to make 1.5 ATRs, then you're talking about making about 5. So you have to say, well, I think it can go to 97. That's a good trade. But then you have to say, if I want to risk down here, which is more like $5 or 1.5 ATRs, do I think it's going to go up 3 ATRs or close to $10, 102? I'd say that's also within the realm of possibility, considering it's not going to new highs. And I'm not saying buy it or don't buy it. I'm just trying to show you the thought process that goes through my mind right now when I'm looking at a particular sector and group that is starting to look better. And I was very negative UA coming into this year. And now I'm starting to see the possibility of this thing has bottomed out. So now let's move on to another one of our family members, and that's our prodigal son. And, you know, a lot of resistance up here, a lot of talk about what the Fed is going to do. This is an unknown situation. I think trying to figure out what the Fed is going to do is probably going to make you nuts, especially since I don't even think the Fed knows what the Fed wants to do. But nonetheless, it looks pretty good, holding up at these levels right here. I think I had mentioned that 45, 42 or something was the old high close, and that was a pivotal area. It remains so, and obviously it has to get through 46. But you've got a risk situation, so that's something to consider. Therefore, you want to look at some of the regional banks. And, you know, you can always find which stocks are in the basket of any particular ETF and which ones are the heavily weighted by looking it up online. Now, if we move on to IBB, IBB is still in a weak recovery phase. So it's very clear what your risk is here. I'd say down to around 322, and it would have to break 340. So now you're talking about $18, again, more than 2 ATR's risk. And that's the problem right here. I mean, some of these trades you can say, oh yeah, it looks like it's going up, it looks like it's going down. But if you don't have a good risk reward scenario set up, personally right now, for me, I would avoid that trade. But 340 is definitely your spot, and if nothing else, for overall confidence in the rest of the Modern Family, that would be key. If we move over to semiconductors, you still have a relatively good risk reward situation right here to these moving averages at around 54, let's call it. But again, running into some resistance. So this would be one that I would keep an eye on, particularly some of the big stocks in this group, like Intel, which looks very good, looks actually better than the semiconductors does itself. So that would be a possibility, again, if you could see your way to a risk. I know Jeff was liking Texas Instrument. It's consolidating, far from this risk here. So again, you'd have to use more like a chart point like 50. So here's another one, ITB, not in the Modern Family, but I had been telling you about these converging moving averages, and then once it broke 2770, it was a good buy, again, depending on where you wanted to risk. For a active trade, risking anywhere from a half an ATR to 1.5 ATRs, looking for 3 ATRs, possible, but I didn't love it. So this was more like, let me risk a half an ATR when it broke out that day, down to the low of that day. I think I even tweeted it out. And at that point, you would have reached targets. Now let's go back to the other parts of the Modern Family, IYT. This certainly isn't wowing me right here. Of course, we have Black Friday coming up, other than the fact that it is holding, it has higher lows, and it is holding the 50. So this definitely needs to prove itself. And if we can get through the 200-day moving average, I would feel much more encouraged about that. So let's see, I covered semiconductors, biotech, regional banks, retail, IWM. Have I missed anybody in my Modern Family? I don't think so. Okay, so let's move on to more commodities, but before we do, let's take a look at the mighty TLTs, which I've said is not in my family, but was definitely one that I've been keeping track of. So you can see you've got an upward slope on the 50 overhead. So this is a weak bearish phase, if you can believe that. And you've got certainly now 120 would be your closest pivotal point. So if we can get through 122, then I think that that would be very interesting for commodities. Equities, I think, will be a little bit confused. Does it mean that the Fed is going to keep rates the same? Does it mean that the Fed has lost hope in the fact that the economy can have any kind of sustained recovery here? I mean, these are the kind of questions that have to drive anyone insane. So that's why my bigger suggestion is to look at the merits of each individual stock and make your decisions exactly how the mindset was that I just talked to you about. Risk versus reward. Where has it been and where do you think it goes? And then if that makes sense, then determine what your position size should be accordingly. So that leads me to commodities. So let's take a look first of all at USO, because that is probably the most often or frequent question I get is, what do I think of oil? And right now it's hard to think about anything really. It's just sitting here trying desperately to hold this bottom at around 13. And I don't think really it gets interesting to me until it breaks 15 to the upside. However, the fact is I wouldn't necessarily be short this, and I explain a lot more about that on Benzinger. But what I do like are the oil-related ETFs like XLE. And those of you in Vantage know that we tried a half a position in XLE. When it dropped down to here, we were already gone. We missed this first move. It dropped all the way back down again. And now at this point, would I be willing to try it again? Yes, probably if it breaks over 70. And I would probably say at that point, you would have a couple of ATR risk, but you would also be saying that I see there's resistance up here. I'm betting on the fact that it's going to break out over that resistance, because at that point you would have more than a 2 ATR risk down to the 50. That's for a swing. The one I like even better here is XOP. And the reason why is because XOP, you can see here, is having a really nice consolidation between 40 and 36. If you wanted to get involved, you would probably use a risk to around 36, which would be good for a more active trade. If you want to wait, which is what I intend on doing, then you'd want to see this thing break out over 40. From 40, at that point, you might see this 50-day moving average moving up, so you would have a risk somewhere around 37.5. So with a $2.50 risk, that puts you in a very well situation for a swing trade. So that's something else I'm watching. And then, of course, there are some energy and oil related stocks that I'm keeping an eye on, like XOM, Exxon. You can see it made this big move up, dropped all the way down to test that 50, now is sitting pushing against this 200-day moving average. I think that's something to keep an eye on as well, just for an example. Now let's move on to the metals. So if we look at gold, I keep telling people I wouldn't necessarily go short, but it's certainly not giving you any reason to go long. I think 104 would now at this point would probably be more convincing to me. But what does look good are the miners, and here's GDX. I'd like to see a close back over 14. If we get that, you see how you have a decent risk. It's about 2 ATR risk down to around 13, but from 14 you would have to be saying, do I think it could go up to 16? And I would say that that is definitely within the realm of possibility. So there's one to keep an eye on. As far as silver goes, that tested 1340 again, but at this point, just like with gold, I probably would want to see this get back over 1380 before I would put my money down, and 1340 would be my risk. Now, one thing I do like, and I almost bought today for advantage, but I decided that it would probably be prudent to wait, and that is U.S. Steel. Why? This was a classic reversal yesterday. We had great volume. We had a little bit of an expanded range. It closed in the top part, and now today you're getting your follow through. Now, if we take a look at the pivot chart, it hasn't gotten through R1. R1 comes in at 838, and we have to wait for that technically because it has had negative pivots as even a better confirmation. Otherwise, what could happen is it could rally up near R1 and then reverse. So I'm going to be a little bit more patient here, but don't be surprised if you see a position based on the strong reversal pattern. And that covers the metals and the oil. Let's move on to some of the soft commodities here. Okay, starting with, let's look at coffee first. This is actually JO. And you know I've probed this a couple of times, but that didn't stop me from wanting to get back involved. And so we actually bought it on this day right out of the gate, 1895, and now we have our stop underneath 1850 at the original stop at 1844, but we only have a half a position, which for now is fine because it still has to prove itself. So what would make me get more aggressive with adding would probably be a confirmed recovery phase. So we had one day. If we get a second close here over that 50-day moving average, then I would probably not only go in with the second half, but I would probably raise it up to a no loss stop on that or just under the 10-day moving average. So I still like coffee. I believe that this has bottomed out. There's not much to see here on the longer term charts. Because we're still well underneath it all. So it's really more a matter of looking at the bottoming formation and then I think getting through the lows that we had in 2013, which if we look, the low in 2013 was 2037. So at that point now, 2037 is definitely some resistance, but if we can get through 2037, which would be like around here, then I believe that we can see a nice pop in coffee. So that's something to keep an eye on. In terms of sugar, sugar made its move already based on some good fundamentals and technicals. Now you can see it had a big reversal. And I wouldn't touch it right here. I mentioned on Benzinger that if it can get some kind of consolidation somewhere, if we take a look at the cash sugar, which is a little bit easier to read, somewhere between 14 and 14.5 is where I see this going. If it holds and holds that 50, then maybe I'd get back in, but for right now I'd leave it alone. The ones that I'm also keeping an eye on though are corn. Hasn't really done anything yet, but looks like it's trying to base. And also cotton. Hasn't really done anything yet, but looks like it's trying to base. It went up a little bit today, back over the 50, but every time it does that, it runs into some resistance at this 100. So I'm keeping an eye on that. And then if we move into the actual basket, which is DBA, this is what I find most interesting here. So with DBA, we have a trend line that comes in from the high up to the recent high in July. And that's a valid trend line because we made a new low. So actually right here. So you can see the trend line comes in underneath the 50. If we break out over the trend line and then we can get back through this 50-day moving average, that's another what I think to be a very interesting play as we go into 2016. And DBC, not quite as clear cut, but I keep my eye on this as well. We haven't had any kind of strong moves that I can see so far, but this would certainly be more based on what oil does here and whether the metals stabilize, and of course, as I pointed out to you before, that GDX, which looks relatively decent. So if you haven't gotten into anything at this point, I'd say it probably behooves you to wait, whether you want to trade on Black Friday at the half a day or want to wait till Monday. Remember, risk reward is going to be the most important thing no matter what it is you want to get into. And that's going to be, again, based on the merit of each individual equity or ETF with the overall macro picture in mind. So I hope that was helpful to you to give you some trading ideas as we end 2015, go into 2016, an idea of how to look at daily and long-term charts and even some pivot charts to determine your entries, what type of risk you're looking at versus what type of reward. Didn't get much into position sizing. We'll do that at another time. But in the meanwhile, have a wonderful, happy Thanksgiving. I leave you with a look at NASDAQ, which has been the mighty sword this year and continues to be so. Obviously, we haven't gotten through the recent highs, but it's holding up very, very well. So, again, Mish at MarketGauge.com should you have any questions. And I hope you have a very healthy and happy holiday. I'll be back with you all on Monday. Bye for now.